afternoon, everybody. I'm Stephanie Price, the telecom and tech analyst here with CIBC. Up next, we've got CGI. CGI really needs no introduction, but it's Canada's largest independent IT services firm that provides end-to-end IT and business consulting. So we're very pleased to have George Schindler, President and CEO, here to provide us with a bit of an update. Welcome, George.
Thank you. Thank you.
So I'm going to start out with maybe some general thoughts on the demand environment. There's obviously a lot of headwinds, a lot of uncertainty out there. We just got a interest rate comment from the Fed. Can you give us a bit of an update on what you're seeing in terms of customer spending patterns and sales cycles here?
Yeah, we're seeing the spending patterns stay pretty consistent, quite frankly. The quote, I was in Europe last week, and the quote from one of the executives I spoke to is the digitization race. We've come to the conclusion that the digitization race never ends. And that's pretty much what I heard here consistently, and we see in some of the spending patterns that clients have resolve around digitization, a little more focus on the business case and the outcomes, and a lot more focus on the cost savings, but they're not giving up on digitization. And so the spending it's consistent with what we saw in our survey that we did right at the end of the pandemic, that IT budgets are staying pretty consistent, even in the face of some of the obvious headwinds that people are facing.
You mentioned Europe there, and
Yeah.
I want to dig into Europe here. It seems to have remained solid for CGI, but there's obviously some potential headwinds there. And so is the demand environment, or is the outlook in Europe from customers different than North America, or how are you thinking about Europe here?
It tends to be a little stronger here in North America for obvious reasons, because we're a little bit further from the conflict. The conflict is a little bit more real for them. But so you're hearing more. I certainly heard a lot more about the need for cost savings. Of course, that drives them more to some of the services that we have around managed services, around IP. And the other theme that I heard loud and clear was maybe a move more to vendor consolidation. Vendor consolidation is a way for them to deal with some of the uncertainty. It's quite frankly, it's more elastic. It's more dependable and flexible, if you will. And so I heard a lot of that, and that really spanning my last 3 trips to Europe, starting in the spring, and it's a pretty consistent theme that they're moving more to vendor consolidation. The next wave of vendor consolidation.
All right, so let's switch over to M&A then.
Yeah.
Just given that comment around vendor consolidation, obviously CGI has a target of $800 million to $1.2 billion in M&A for this year. It looks like you're close to that bottom end of that target.
Yep.
Curious how you think about the M&A environment here, both right now in terms of valuations and also as you look out into 2023.
Yeah. So clearly, valuations in the public based companies have come down in our space, and we see that as an opportunity. At the same time, some of the competition, which given the cash generation opportunities in a business like ours, and the targets therefore that we're looking at, PE has been a pretty active player. Given the interest rate rises, which continue obviously this afternoon, we see a little less of that competition because their value proposition changes, and so that also drives valuations down when you have a different competitive landscape. And we see the exact same thing transferring to the private side of the house. A lot more reasonableness in the valuations, and because of the vendor consolidation, which we see across the board, more impetus for some of these smaller and mid-sized companies to want to team up with a company like CGI. So a lot of the stars are aligning, which is why we expect to do the same or more in this next year than we did in this past year.
Okay. And acquisitions, you've obviously focused on metro market as kind of your sweet spot. How do you think about metro market versus larger transformational deals in the current environment?
Yeah, well, I'll remind you what one of the reasons we went to the metro market acquisitions are the really large ones are there are no hostile takeovers in this business. You got to have a willing party on the other side. It's a bit of courtship. It's hurry up and wait and hurry up. And we didn't want to miss the opportunity to continue to grow our business. At the same time, we were in a different place. When we were entering more of entering the U.S. market, or entering the offshore market, or entering the European market, like some of the big ones from our past, you needed a bigger one. Otherwise, you weren't going to get there. Now that we're in all those markets, we can have the metro market strategy at the same time that we look at the others. To your specific question, we still prefer the big one. So we still have the appetite for the big one. We've developed a muscle. We've been very deliberate about acquiring in every one of the major geographies that we operate in, so that we're positioned to actually do an integration faster and more successful than we've done, even more successful than we've done in the past. So we're positioned for it, but we're going to be disciplined. We're going to take the right one. Too much value destruction versus creation in some of these large ones, and we have not done that because of our patience.
When you think about value destruction, are you talking in terms of infrastructure assets that are maybe older and
No. I'm just talking about a lot of these acquisitions aren't accretive.
Too expensive?
They're not accretive, right? So they're dilutive. So you can see some of the big goodwill write-downs. I'm not going to talk about any specific ones, but so it's just a point that we're going to be disciplined in this.
That's fair.
But we do prefer the big ones.
Sounds good. Are there any questions from the audience on M&A? Maybe I'll switch over to IP30. So just curious around where you're seeing the most demand as digitization accelerates, and as you think about IP30, what's the mix of acquired versus organic? And I'll throw one more in there. I saw that you just announced a partnership with UIPath this morning, and so how do you think about partnerships with IP30 as well?
Yeah, well, maybe I'll start with that, with the last question. We see right now, point in time, an even bigger opportunity with our platform partners, our hyperscaler partners, and partners like in automation, like UiPath, to come together in cooperation, because, as I mentioned, clients are looking for more of that solid business case and business case return. That requires an actual solution on top of the platforms. And so for us, we get the opportunity to use the platform providers' reach and channel. They in turn get to use the CGI solution to have a clearer business case for our collective clients. And so the UiPath is one example of that on automation as a service, which is certainly an area that a lot of clients are investing in right now to get cost savings. So that's a great one, and we'll go to market together on that. We've done the same thing with Microsoft and our open media solution. We've done the same thing with Google in our retail suite. And it's a matter of matching up where the strengths are in both companies, and then going to market together. So we'll continue to do that with IP30. As far as acquisitions versus growth, we are growing our IP portfolio faster than the rest of CGI's growth. Unfortunately, you don't see that, because at the same time we're doing that, we're acquiring companies that don't have any IP. And so there's a dilutive effect, not on the actual revenue from the IP, but right now it's skewed. So if we're growing 50% organically and 50% inorganically, and right now we're actually growing a little faster organically and a little slower inorganically, but still there's out there. If you're growing 50-50 and we're growing organically our IP faster, but 100% of our inorganic doesn't have IP, we're mitigating it. So we need to ramp up the inorganic growth. It's been a bit slower because we've been very disciplined in building a pipeline. We're not after just your traditional software players, because their relationships tend not to be with the client. Their relationships tend to be with providers like CGI, and because that's their model, right? And they don't really have the services power. That's okay, they don't have services, but to the extent that they don't have relationships with their client, that becomes more difficult for us to bring into CGI and get the 1 + 1 = 3. You get 1 + 1 = 2, but we want 3.
That makes sense. The one area organically CGI has been looking at in terms of IP is moving some of your North American IP into Europe and vice versa. How is that going, and how are you seeing growth in those markets?
We've got some very good traction going from North America to Europe, particularly on our banking applications. So that's going extremely well, and it's driving some of the growth in the IP. And you've probably seen some of the announcements there. We have opportunities, continued opportunities in bringing European IP to North America. Not as good a traction yet. We're getting some interest, but we don't have a base yet, and so that's going to take a little bit more time. You know, areas like bringing our retail suite into the U.S. or bringing our open media into Canada. There's opportunities are there. And we've made the investment, so the IP applies, so we don't have to make investments in the IP, but part of it is just the receptivity, and it takes a little bit of time to be known in the marketplace. So I think that's an activity that we continue to invest in. And then the most exciting part is we actually are building now some joint IP between the two countries. So for example, a lot of what we did on the Open Grid 360 and some of the derivatives of that is taking into account what's going on in the European energy market and what's going in utilities market and what's going on in the North American utilities market, and kind of building the software for purpose on both and marketing it from the beginning as both. We're doing that actually, even sharing some of the government smart cities work. So it's coming along, but it's not automatic. It's not happening overnight.
Yeah, that makes sense. Maybe switching gears a little bit onto the war on talent and attrition. Just curious if you've seen any changes, just given the more uncertain macro environment, and how you're thinking about attrition and the war on talent at this point.
Yeah, well, definitely the attrition rates, or I like to talk about the retention rates.
Sure.
The retention rates have gone up, but attrition has definitely, I would say, peaked in almost every one of our markets. We just went through all the business planning because our fiscal year begins October 1st, and so I went through all that with the team, and you can see that it's peaked. But I would not say it's coming straight down.
Okay.
And certainly some of the hiring, again, in certain markets is easing, but I wouldn't say it's eased. Having said that, just to remind you and everybody here that we continue to have success in hiring. About a third of them are coming as referrals from our people, and that's a great way to get the talent. About a third are coming just through our employment brand. So we're really only actively hiring 1/3 of the people that, going out and trying to get them, which gives us a better mix. And we've hired over 20,000 people in the last year. So we're doing fine on that.
Maybe we can touch on offshore here as well. So you're offshore, you acquired with Logica, you've been building up, and I know you've been using that for some internal CGI function as well. Maybe you can give us an update on how you're thinking about that offshore piece of the business.
Yeah, well, just on your last point there on the using it internally, all that IP30, all that those 190 solutions, they're built in a software delivery center factory in Bangalore in India, and some other locations across India. So that way we have the software engineering tools and methodology like you would in a software firm, and we're doing that in a less expensive location. We've also moved a lot of our internal support work to global delivery centers, including Philippines is a big one for the CGI internal support. But we see more uptake from clients coming out of the pandemic that maybe were more reluctant to put as much work offshore now that they were a little more used to the remote experience. they're more willing to do that. Part of the early days of that were coming out of the pandemic was they couldn't find the talent themselves, and so that's part of what they were looking for from us. Now it's more about cost savings. Having said that, it's still a two-way street in that because of data privacy concerns, because of cybersecurity concerns, and increasingly because of geopolitical concerns. Nobody's looking to put everything in any one location. And I did hear that loud and clear, more pronounced in Europe than here in North America. In Europe, you do hear, tell me about your centers in the EU.
Right.
So for us, that's a good opportunity because for us, it's not onshore or offshore. We have a pretty big contingent of nearshore centers, so we can go there for our clients in a nearshore setting. That gives some more of the balancing, given nobody knows exactly where the geopolitics will land.
That makes sense. Maybe we can translate that into a broader comment around the competitive environment here and how you see the market at this point.
Yeah, competitively, it's in some ways the environment is people are behaving the way you'd expect them to. I don't see a lot of buying business. In fact, in some cases, you might see the opposite. There's some pretty severe pressures right now on some of the India pure plays to with falling margins to maybe raise their rates. I think that's an opportunity for us because they're traditionally known as the lower cost, and so that's an opportunity maybe for us. So as I mentioned, the vendor consolidation is squeezing some of the middle-sized players who have a very good and strong value proposition, but they're getting hit from all sides, right? So they have rising wages themselves. Don't probably have the same pricing power that we have on the rate side. Have additional costs associated with ESG requirements for clients. Clients are increasingly asking, what are you doing in ESG? That takes investment. Asking, what are you doing on data privacy and security? That requires investment. And yet the deals are getting bigger. So that's, competitively, it's kind of moving. And I've said this for several quarters now. The scale actually matters in this type of environment more. And of course, they can't do the global delivery.
Right.
So so they're not as flexible. Back to the why a client would do the vendor consolidation. They want somebody that's flexible to be able to move the work, make the investments that need to be made, maybe even bring some intellectual property in. So competitively, it's a pretty good environment for us.
That makes sense.
Not easy, but a good environment.
Does anybody have any questions in the audience? I wanted to circle back on pricing. You mentioned it a few times. Can you talk a little bit about pricing in the current environment, and if there's been any change in the amount of pricing you've been able to kind of push through to offset inflation? And does that vary by market?
Yeah, I'll tell you, across every market, clients recognize that to get the talent that they need for their projects, and remember, when you get a clearer focus on the business case, the delivery matters. They know that they need the right resources. They're facing the same cost pressures and inflationary pressures that we are, so they recognize that that's going to cost them more. They plan for that. Yeah. So I see that across the board, including in Europe. In fact, I've had clients just in this last trip say, don't let your team get too focused on the rates. We're looking for outputs here, George. So that's a good sign. Yeah. We've built in the indexing to our managed services deals, and we'll go to a client when we go to do that, and we'll say, the rates are going up. would you like us to move more of it to global delivery? That way it's their choice,
Right.
as opposed to just a stance. And we do the same thing when we're raising rates at clients. But we've had some pretty good receptivity there. Remember, we don't start there though. We're also looking at moving stuff to global delivery. We're looking at rotating staff and bringing in a different sourcing mix. We're looking at bringing in some IP where we can, so that we're conscious that we're living within the confines of the client, but holding or increasing CGI margins at the same time. So most of our growth, the vast majority of our growth, is not through rate increases. So it gives you a sense of that's a lever, but it's not the first lever we go to, because if you use that as your first lever, it works the other side as well. So we're pretty conscious of that.
That makes sense. Maybe switching over to managed services, speaking of kind of the big growth drivers here, you mentioned that managed services bookings were up 32% year over year on the last call. Just curious how you think about that managed services in a recessionary environment. It seems like a somewhat recession-resistant part of the business.
Yeah, well, it quite frankly, it gets stronger
Yeah.
during a recession. It's viewed by the clients as an opportunity to deal with some of the uncertainty, because they've basically taken some of the variable work that they have and they moved it to us as a managed service. It solves their talent issue. It solves their flexibility issue. In many cases, it solves a quality issue. One of the clients I was speaking to in Europe basically said, look, we can't get the people. We want to continue to be acquisitive. Our IT won't support it, and we know what we need to do, but we just can't do it ourselves. So that's exactly what you're looking for. And oh, by the way, can you do that in an offshore location so it doesn't cost us as much? And so that's a big driver. So you definitely see managed services go up. I mean, it's the same thing with the IP, right? You want to do it yourself and roll your own in times where it's a little bit better. And you want assistance from firms like CGI, so we can grow in that environment. But in a tougher environment, you're really looking for somebody to take some of those headaches off your hands. And the reality is that all you got to do is look at 08, 09 and how CGI performed, and you see that was a big driver for us.
Yeah, that makes sense. I wanted to touch on book-to-bill. So you had a very strong book-to-bill TTM during the pandemic. It's come down a little bit. I wanted to talk about the puts and takes there. I know the acquisition mix has been part of it, so maybe you could just expand on how you're thinking about bookings these days.
You're right. The acquisition mix is a part of it as we bring on, the $800 million of new revenue from acquisitions. It's almost entirely, just like it dilutes our IP percentage of overall revenue, it also temporarily dilutes our book-to-bill, because we bring on all this revenue and we don't get all the bookings. And in fact, depending on when you do the acquisition, you get the same thing happens on the cash, right? You get the receivables, but you don't have the cash so that resolves itself over time. But in the case of the book-to-bill, these acquisitions, they're primarily pure SI&C, so they have no backlog, and so their bookings are more month or week at a time, and so you don't get that future view. But it's a very strong business, and so it just takes some time to get into the CGI.
And how do you think about the cross-sell and getting these businesses then ramped up to cross-selling your IP and your managed services? How long does that take, and what's kind of the process there? We
do an integration to the extent that we can directly into the CGI businesses, and we try to have a mix of leaders, a couple levels down from both CGI Legacy and the new organization. And then they're part of a broader team so that we can begin to do those channels. And we actually have the meetings, we call them Executive Insights Exchange meetings. We provide them with the voice of the client information, and we sit down with the clients almost immediately within the first 3 months to begin introducing the fuller CGI story. And if you look at where we've done the acquisition, the organic growth is a point or two higher than where we haven't done an acquisition for that reason.
Okay,
Which is why we're doing it.
Sounds good. We have time for one more question. Is there one from the audience? Otherwise, I will ask about capital allocation.
Okay.
So obviously, very strong free cash flow out of CGI. With the new M&A strategy, you've indexed more towards M&A this year. Just curious how you think about the buybacks and the potential for a dividend at some point.
Yeah, well, given everything we discussed here in the last 30 minutes, you can see that we're still in build mode. We still see plenty of opportunities both on the organic side and on the inorganic side. Organic side, investing in our IP and those managed services contracts that we think are going to be even more in demand now, and then investing in the inorganic growth, which I think with the valuations coming down, there's a big opportunity there. We like to return cash to our shareholders, and so we'll do that through the stock buybacks. But it gives us more opportunity, particularly if our appetite is for the big one. We want to have that dry powder. With our bond issuance, we've got a leverage ratio that we want to stay within. We can go above that if we're committed to bringing the debt down rapidly. So we want to be as flexible as possible to be able to go up and come back down without the other commitments. So that's where we are right now. Of course, we will again talk to our board about it. That's the advice they've given us, but we'll continue to talk about it and look at it. And I know we could do both at any point in time, but the question is, what's the opportunity in front of you? Right?
Sure. And when you think about that transformational deal, I'll throw one more in here. When you think about that transformational deal, is there a specific region that you would be interested in bulking up, or is it more just straight, financially driven?
For the transformational deal now at our size, they're almost gonna be in multiple regions.
Sure.
It's almost by definition. They might be headquartered in the U.S. with a significant amount of European business. They might be headquartered in Europe with a significant amount of North American business. But they're going to come with both. And then we're also looking at, we could still do a transformational deal with a really big one and maybe not take all of it, right?
Yeah.
So we would look at that. And that's not unlike what we've done in the past when we brought AMS in and we said, not sure we want to be in the defense market today, given the digestion that we have to have here. And then later on, we bought into the defense market. So we could look at that as well. So there's lots of options there.
Lots on the table. Yeah. All right. Well, thank you very much, George.
Thank you, Stephanie, as always. Thanks.